I will kick us off and then hand over to our panelists. So a little bit about PXD. As you all may know, our approach has always focused on understanding farmers' dynamic constraints in each context, and then designing evidence-based, cost-effective, and scalable solutions to address these constraints. Kenya's dairy sector is one of the largest sectors for smallholder farmers, accounting for about 80% of all producers. So we started working here a few years ago, trying to understand what types of agricultural information we could provide via mobile phones to help them increase their dairy productivity. As we went out and started talking to farmers, consistently across the board, we started hearing that insufficient water during the dry seasons was a key challenge. Cows need water to produce milk, and particularly during the dry season, household members, often women and girls, are traveling long distances to fetch water. So farmers are not only struggling to maintain milk productivity and incomes, but as you can imagine, this also affects things like girls' school attendance. Now, water tanks can help solve this problem. When a farmer has a water tank, they don't need to collect water from long distances, and they can maintain milk production during the dry season. However, water tanks are expensive, and this prohibits farmers from accessing them. This is not a problem digital advice could solve, and that's why we pivoted our approach. We decided to introduce dairies to this asset collateralized loan product for water tanks that you'll be hearing about soon. This is a product that has strong impact evidence, improving not just milk sales, but creating other household impacts as well. This ACL water tanks initiative is what we're going to talk about today. We've put together a group of panelists that will speak about their experience with ACLs from diverse perspectives. First, Paul Nuthu from Kwika Sacco, or Saving and Credit Cooperative Society in Kenya, will share from the practitioner's perspective on their experience providing ACLs for water tanks to farmers. Then, Josh Deutschman from the University of Chicago's Development Innovation Lab will share findings from the research evaluating the ACL approach and the impact that it's having on improving farmers' access to water tanks in Kenya. And last but not least, you'll hear from Abraham Solomon from Precision Development, who will present on our approach to scaling ACLs for water tanks. At the end, we'll leave some time for Q&A based on the questions shared in the box. Please enjoy the event, and over to Paul.
Thank you. My name is Paul Nuthu, Sacco CEO, Quickers DT Sacco. And I'm here to present the information on the research and what we have done here on the ground. Quickers DT Sacco is a Sacco located in Nyandarua County in Kenya. Initially, the Sacco used to operate as a department of Nyara Dairy Multipurpose Cooperative Society, and later we became a registered Sacco as Nyara Vision Sacco. In 2023, we changed our name to Quickers Sacco, which was driven by the need of opening the common board to accommodate people from all sectors of the economy to be eligible to become members of the Sacco. We now continue serving dairy farmers as well as other members of society who need access to financial services. There are many assets that would help farmers improve their livelihood, but it is very hard for them to save enough to purchase them. There are many reasons for this, and one is many people have low income from livelihoods that depend on agriculture. Also, they have many other financial needs such as school fees, medical expenses, and emergencies. Many people also still have a knowledge gap on the benefits of financial savings. Although it is hard to save, there are also many challenges farmers face who need to access loans from SACCOs and other sources. One is that SACCOs usually require a long duration a member should save with them. That is an average of 6 months savings. There are many assets that would help farmers improve their livelihoods, but it is very hard for them to save enough to purchase them. There are many reasons for this. First, many people have low income from livelihoods that depend on agriculture. Also, they have many other financial needs, such as school fees, medical expenses, and emergencies. Many people also still have a knowledge gap on the benefits of financial savings. Although it is hard to save, there are also many challenges farmers face who need to access loans from SACCOs and other sources. One is SACCOs usually require a long duration and members should save with them. That is an average of 6 months savings. To get a loan from most SACCOs, a farmer has to go through many steps. One is that a member has to prepare an application, and the member submits that application form, providing information about the purpose of the loan, the amount requested, and collateral or guarantors. Next, there is the assessment, and the SACCO loan officer reviews the loan application and assesses the member's creditworthiness. This assessment involves evaluating factors such as the member's income, credit history, savings behavior, and ability to repay the loan. Finally, it goes to the loan approval, and based on the results of the loan assessment and credit investigation, the loan approval authority decides whether to approve the loan application. The ACL model is very different than the traditional loan. First, to make repayments, the daily cooperative channels loan repayments to the SACCO. This is made as a deduction from the payment the dairy cooperative gives to farmers every month for the milk they sell through the cooperative. Second, the water tank itself acts as a collateral. And third, there are no guarantors required to take liability for the loan. ACL have an extended loan repayment duration compared to traditional loan, that is 24 months. Finally, the SACCO organizes transport for the asset, that is, the tank is delivered at farmers' homes. From 2007 to 2012, Quickers offered ACL as part of a pilot project, which researchers from IPA to see if the ACL model could work. The idea started after farmers came knocking our doors for a loan which did not require collateral. At first, we thought there was a risk of defaulting in loans if we didn't follow the traditional loan requirements. During this period, we provided 1,100 farmers with ACLs, and we learned the product could address farmers' credit concerns, and so it resulted in very few defaults. This helped us learn that the demand for water storage among our members was very high. After this pilot, we decided to keep offering farmers with asset collateralized loans for a number of reasons. One is that we saw there was a high demand among farmers in and outside the study. Another reason is that the tank loan provided multiple benefits to our members. And also, from a SACCO's perspective, it was a good revenue source with low risk. Since the end of the study, we have provided ACL loans to 3,990 members. This is worth over $1 million that we have been able to channel towards providing farmers with water. Based on the success of this model, we have plans to continue offering ACLs and developing new innovations with it. This includes continue promoting asset collateralized loans as favored product within SACCO's network of branches. Of course, there are challenges with the ACL model. One is during periods of long drought, late payments become more common due to reduced milk production. Some dairy farmers would want to get a water tank, that is ACL, but they have periods when their cows are not producing enough milk for us to issue them with an ACL. In new areas, farmers take time to trust in a new product, like an asset collateralized loan. Due to the above challenges, Quickers has introduced some solutions that have addressed these issues. The SACCO has lately introduced the factor of a follow-up partners to mitigate the chances of default. The role of these follow-up partners is to keep an eye and pass information in case the loanee decides to sell or relocate without the SACCO's knowledge. In addition, we have introduced relaxed late payment periods that is up to 60 days. Due to periods of low milk production, we now accept flexible loan repayment requirements, that is, cash could alternate check-offs in drought periods. Finally, the microfinance groups, we offer asset collateralized loans also help ensure their members pay off their loans. But the main reason we keep offering asset collateralized loans is that we see it has a positive impact on our members' lives. Asset collateralized loans help new farmers access credit who otherwise would not be able to get it. Also, farmers become SACCO members and they own shares. Three is that farmers increase milk production and income, and they also access to other assets using tanks as collateral for other loans. Other SACCOs could also offer ACL loans, but they face some challenges to also scale this up. One is that there is strict microcredit requirements, e.g. guarantors' responsibilities. Also, assets given as loans are rarely used as collaterals. Also, there is the knowledge gap, or even in marketing or capacity building among farmers. Lack of liquid capital, and also partnership between dealers and SACCOs. There is also a technology gap or lack of strong ICT systems. These challenges can be overcome by helping them with institutional capacity building and also access to capital. Thank you very much.
Thank you, Paul. We're very grateful for you sharing your experience with ACLs and your institutional knowledge with all of us at PXD and beyond. Next, I will hand over to Josh to speak more about the evidence associated with ACLs.
All right, thank you very much for having me, and thanks to PXD for organizing this great session. So just to provide a quick introduction, so the Development Innovation Lab is an organization, a policy research and innovation organization that's housed at the University of Chicago, and founded in 2021. Actually, I should know that. And DIL essentially aims to use the tools of economics to develop innovations with the potential to benefit millions of people in low and middle income countries. And we're very happy to be working closely with both PXD and Quick SDT SACCO on work to iterate and scale this really effective model. So I'll talk a little bit about the research that backs the work that we're doing together, and share some perspectives on how this can help the scaling effort. So next slide, please. Just to give a bit more background, some of this has already been said, but farmers need durable assets like water tanks and other things like chaff cutters, both to improve their productivity, but also their climate resilience. And in parallel, we know that savings and credit cooperatives are a common source of agricultural finance for farmers, and especially so in Kenya, where there's a really robust sector of SACCOs serving farmers. And the traditional model that SACCOs have followed for asset financing is typically very risk averse. So farmers need to essentially provide the entire balance of the loan as collateral, typically in the form of shares promised by guarantors. And so this is potentially a high barrier to entry and limits farmers' access to credit. So as Paul mentioned, Quick has partnered with researchers to test this alternative, asset collateralized loans. And in this case, these loans required only a security deposit covering some portion of the loan balance and allowed the remainder of the loan to be collateralized by the asset itself. Next slide, please. So this was studied and analyzed in a paper that was published last year in the Review of Economic Studies. And the authors of that study essentially analyzed the randomized trial that tests this asset collateralized loan product against the standard cash collateralized loan, so that we can say for sure the causal impact of offering this new loan type. And so first, I want to really highlight that the research points to dramatically increased loan demand for asset collateralized loans. And when moving all the way to 96% collateralization, requiring only a 4% security deposit, this increased loan demand by about 20 times compared to the traditional loan. So this was an enormous increase in loan demand and in loan take-up, with essentially a very small increase in lending risk. Under 75% collateralization, there were no tank repossessions that occurred during the study. And even under 96% collateralization, the repossession rate was extremely low. So essentially, this involved an enormous expansion in credit access with very little change in lending risk. Next slide, please. And we can also tell from that study that this model had real impacts on farmers. It increased monthly milk sales by an amount that corresponds to about 10% of household monthly expenditures. It increased water storage capacity. There's evidence of improved cow health, perhaps because farmers needed to spend less time taking cows to walk for water, which is both exposes them to pathogens and can reduce their health directly, but also has productivity impacts because cows spend energy walking rather than spending energy producing milk. And there's some evidence too of improved school attendance for girls, which is also consistent with spending less time fetching water. Next slide, please. So on the results of this study, DIL and PXD have partnered to in part replicate the results with additional cooperatives in the Rift Valley region. And alongside that, we're testing some additional innovations to provide kind of product development and provide a roadmap for scaling this up more broadly. So one of these innovations is an income sharing loan that we're testing alongside a declining balance loan. And so this has some features that may reduce the risk for borrowers and essentially allow farmers to pay more when their income is relatively higher and pay less when their income is relatively lower, which may be appropriate for farmers who face a lot of seasonal variation in their income. And we've done some tests and find that demand for these two loan types is broadly similar, although there's some potential differences by gender and the size of the loan that we'll dig into more as the research progresses. And there's some indications that, consistent with what we might expect, that access to water from water tanks may have some benefits for household health. Next slide, please. We have some additional research in progress that is complementary to this and to this larger scaling initiative. So we're looking at the longer term impacts of water tanks, following up on some of the participants from the original study with Quikas DT Saco, looking at impacts on production, on climate resilience, and on broader farmer investment. And there's some preliminary evidence that these water tanks do help farmers maintain increased sales for weeks following the start of a dry spell. So this points to the potential for avoiding income losses, and which may become a bigger issue over time as the climate changes. And we also have some more research going on contributing to ACL product development, testing longer lived loans, which might be more appropriate for assets with a really long lifespan and low depreciation, and might also be more accessible for farmers with lower incomes. And also some additional tweaks that incorporate elements of a layaway savings plan and allow farmers to save up for the security deposit, which again may increase access for farmers with lower incomes. Next slide, please. So as we continue to work together to scale this model, we will also continue to work together to learn about the barriers to scaling evidence-based innovations, including asset collateralized loans. And we hope that there are lessons that reach more broadly than that. As mentioned, we think that some of the potential barriers in particular for other SACOs to take this model up include knowledge, technical capacity, and access to external capital or access to lending capital in general. And that's consistent with some evidence from a previous scaling effort that JPAL and IPA led in Rwanda, which provided a very light touch intervention, provided a simple training on the asset collateralized lending model and did achieve some modest success, but didn't seem to fully relieve all of these potential barriers. And so what we'd really ultimately like to figure out is how we can kind of cost effectively address these barriers and really catalyze much wider scaling to bring this innovation to benefit millions of people. And so I will turn it over to Abraham to talk more about that, but thank you very much for your time today.
Thank you, Josh. Before we hand over to Abraham, I think the team has put together a short video about users that have experienced asset collateralized loans for water tanks. So can we play that now, please?
Marĩtwa makwa njĩtagwo Regina Irimũ, na gũkũ nĩ rwa Kahũtha, ndutaga mawĩra ma ũrĩmi na kũrĩithia. Haya, gĩtũmi gĩakwa gĩa kwenda gũkorwo na itangi nĩ gũkorwo harĩa tũtahaga maĩ nĩ haraihu. Rĩngĩ nĩ ũkuona indo icio igĩtangathithio, na kana ũgathiĩ kwa neighbor ũkona we ndarathumbũka nĩ maĩ. Na nĩ tũkĩthomithagio kũndũ ta Nyara wega wa itangi. Haya, wĩna itangi mũciĩ ndũngĩte time. Nĩ ũkũhota kũruta mawĩra maku ũrĩ o hakuhĩ. nĩ nducĩte ng'ombe ta ithatũ ndwarĩte bĩthi ĩgathiĩ ĩgaslide ĩgathiĩ ũguo nona ĩgũcoka yũke ĩgambe ciĩkue mũgũnda no hũrire maĩ kuma rũĩ mũciĩ ndikĩhũraga nguo ta ng'ombe ta ici
nditega mũno nditagwo rungu wa irimũ makahũtha location na ndĩ mũrĩmi wa iria ndona bata wa gũkorwo ngĩkua itangi rĩu tondũ nĩ ndathĩnĩkaga rĩrĩa itarĩ na handũ ingĩkĩra maĩ na ndarĩoya nĩ nyonete umithio warĩo tondũ nĩ rĩteithagia harĩ kũrĩma na kũhe ng'ombe ciakwa maĩ ngahe tuta ciakwa maĩ rĩrĩa ndĩrarĩma na gũkũ mũciĩ ngahũthĩra na kũhũra nguo maĩ ma kũnyua ma kũhũthĩra gũkũ nyũmba na gũthambia indo na kĩrĩa niĩ nĩ ndeithĩkaga tondũ rĩrĩa rĩ haha rĩ nĩ rĩ save mathaa makwa tondũ ngĩkauma haha nginya rũĩ rĩ nĩ haraihu. Haya ũndũ wa kerĩ ciana nĩ iteithĩkaga tondũ no maumĩra cukuru handũ ha kwamba gũthiĩ rũĩ rĩ magoka makaruta mawĩra marĩa me mũciĩ no njuge kuma rĩrĩa ndagĩire itangi rĩ ng'ombe ciakwa nĩ ikoretwo irĩ safe tondũ nginya rĩngĩ nĩ ũkoraga ciathiĩ rũĩ ciathiĩ kũnyua rĩ ũgakora nĩ iraikaria ũgakora nĩ ciunangĩirwo magũrũ kũu no rĩrĩa i haha mũciĩ rĩrĩa iranyuĩra haha mũciĩ ikoragwo irĩ safe na kĩrĩa arabu ona iria rĩkoragwo nĩ rĩrongerereka tondũ haiguaga maĩ wega itarĩ na ihenya itiratindĩkana tondũ rĩngĩ ciathiĩ rũĩ rĩngĩ ũkoraga yaumĩra rĩngĩ kũnyotoka yanyotoka nĩ kũhũrwo yahohwo yume no rĩu haha gũtirĩ handũ irahatĩkana.
Thank you. Today I'll be talking about Precision Development's approach to scaling access to ACLs for more dairy farmers in Kenya. As Josh and Paul have already highlighted, there is great evidence that ACLs are highly impactful and financially viable from the completed RCT and ongoing research findings. But to scale this up, we need to catalyze the process of local stakeholders validating the model. There are an estimated 1.8 million dairy farmers in Kenya. In many counties, a significant proportion of the farming population keep dairy cows. And these dairy farmers have a great need for on-farm water storage for the reasons we've already heard. Dry periods are already a reality for this large group of Kenyan farmers, but we can also expect greater variability in precipitation in the coming years. Given this higher variability of precipitation, water storage options will be increasingly important assets to adapt to the changing climate patterns. So it's clear why farmers would want to have water storage on their farms, but what's preventing them from purchasing these tanks? Roughly 70% of Kenyan dairy farmers earn less than $5 per day using PPP rates, and saving for a water tank that costs over $250 is a difficult prospect. Accessing traditional loans is also a problem for this segment of farmers who often don't have the required collateral, banking history, or guarantors needed to access credit. Loans to these customers is also perceived as high cost and risky by lenders. As we've already seen, there are a number of differences between the standard lending and the ACL model, and I'll just highlight a couple of other things about it. The ACL approach improves access to these underbanked farmers because of two main elements. The first is the product itself, which is water tanks, which can serve as collateral for the loan. The second is the approach of leveraging farmers' relationship with cooperatives, in this case, dairy cooperatives and SACCOs. The water tank product has a couple of advantages that make it work as an ACL. First, water tanks are highly valued by borrowers, but they also are an asset that serves as a good form of collateral. This is because the tanks depreciate very slowly and have nearly as much value, even in the rare case that they have to be repossessed. As we've already seen from Paul's experience in Yala, only 14 tanks have been repossessed out of the roughly 4,000 they provided over recent years. Leveraging farmers' relationships with cooperatives is the other key element of the approach, and the value of this relationship means that many lending requirements are overly restrictive using the traditional lending models. Farmers get access to inputs, veterinary services, advice, and stable market for their milk from the cooperatives, and this means farmers have a very strong interest in keeping a good relationship with the dairy, making defaults less likely. It also makes it easier to screen applicants and recover repayments through the milk the farmer delivers to the cooperative. And this credit screening is based on farmers' history of interacting with the dairy and doesn't require extensive banking history or business records. As Paul from Quigas has already shown us, This model has been working and has a large potential for scale. The existing landscape of SACCOs and other lenders have the ability to reach hundreds of thousands of more farmers with this approach, but there are some initial concerns and challenges that need to be addressed so that they can be willing to take it to scale. SACCOs are well placed to offer loans to dairy farmers, but there are still some barriers for them to scale the approach. First, SACCOs are often conservative in their lending procedures, and this usually follows the traditional practices that Paul has talked about. Second, SACCOs don't often have enough capital to offer ACLs to all of the farmers who would want them. Also, in some places, farmers don't have a strong SACCO in their vicinity where they can access credit. Banks and other lenders can come in where SACCOs lack capital or there are not strong SACCOs to serve farmers with credit. However, banks and other lenders also have a perception that lending to agriculture, including dairy, is high risk, and they may worry that the cooperative or dairy may not have the management structures in place to be helpful in recovering loans. Finally, for both SACCOs and other lenders, a strong proof of viability would be needed to gain more interest in rolling out the product to a large number of farmers. It's one thing for us as researchers and nonprofits to tell lenders that ACLs will work, but to scale this up, they need to have hands-on experience that is viable within their own institutions. So PXD is working to address these barriers faced by different organizations needed to scale up ACLs. We're doing this in various ways. First, we're working with dairies and SACCOs to understand the key processes of the ACL model and help them put systems in place for managing it effectively. Second, we're also working to bring on board financial institutions, including SACCOs and others who can pilot this model with dairies we've identified. Third, we're developing a knowledge base of the dairies that can serve as a pipeline of customers that SACCOs and other lenders can work with. Fourth, we're working to bring in additional lower cost sources of funding to help catalyze SACCOs and other lenders to experiment with the model and reach a greater number of farmers. Maybe most importantly, we're helping both SACCOs and other lenders tailor the approach and go through the initial phases of ACL lending. This is to help them validate that the model works within their context and get internal buy-in that they need to deploy more funds to ACLs for water tanks. Because dairies have different contexts and relationships to lenders, we're working to develop options for farmers and dairies with different resources to access ACLs. For dairies that work closely with SACCOs, we are working directly with management to introduce and adapt the ACL approach to their product offerings. The experience of Quickos SACCO and Yala Dairy shows just how well this model can work. Some SACCOs have enough capital to deploy a large number of tanks if they're convinced that the ACLs are a good product for their members. But even for SACCOs and dairies that may not have a large amount of funds available for lending, the process of working with them to offer ACLs as a pilot can build their experience with the model, and that would be a foundation for attracting additional capital from other sources. For SACCOs with inadequate capital to provide many ACL loans, we are working to bring on board lenders with lower interest rates, which SACCOs can use to on-lend to ACLs to farmers. Because SACCO lending rates are typically lower than most other financial institutions' lending rates, it's hard for them to absorb capital from banks. However, there are some lenders and potential sources of investment that could set up a fund for ACL lending that could be channeled through SACCOs. And we're working to connect them to the SACCOs who have ACL lending capacity and build a pipeline of SACCOs who can absorb these funds. Finally, we also want to develop ACL solutions even for farmers and dairies that don't have strong connections with SACCOs. This means adapting ACLs in a somewhat new way, such as working with banks, MFIs, or other lenders to offer farmers ACLs directly through dairy cooperatives. And we're working to link this pipeline of dairies with SACCOs and who to access these lenders. At the same time, we're working with these lenders to adapt the model to fit into their internal processes to see if they can make ACLs available. So we've seen interest from the financial institutions in Kenya to try out ACL lending and have identified some key partnerships that could help channel more funding through SACCOs towards ACLs. And these institutions have a huge capacity to scale ACLs if they become convinced the model is financially viable. As we've already seen, PXD is working to catalyze the process of these institutions to validate the model for themselves. And because of this, a relatively small amount of funds to de-risk or provide lower cost capital for the initial learning process could unlock much greater sums that these institutions could deploy towards ACL lending. So thank you for taking interest in our work on spreading the ACL model. This approach has a huge potential to improve farmers' incomes and be offered sustainably by local credit providers in Kenya and beyond. We have great evidence that ACLs are highly impactful and can be financially viable from the completed RCT and ongoing research. We welcome the participation of anyone else interested in helping scale this approach and to hear your feedback and suggestions for how scaling can be improved. So we look forward to your questions and engagement going forward, and thank you very much.
Great. Thank you, Abraham. With that, all our panelists for the day have completed their presentations. We have a few questions that we'll get to, and I would encourage anyone else that has questions to post those on the box now. We will try the video one more time if it works before we jump to Q&A. Nick, over to you. Okay, no luck. I think we'll abandon ship there, but we will make sure to send the video via email, and thank you to everyone for bearing with our technical glitches. I think we have a few questions in the Q&A box that I will now read out, and we'll keep updating those as more questions come in. So Paul, I think there's quite a few questions for you that have come in, but I think the first one is, the first question is about what did farmers use the water for? Was it mainly for watering cows, or are there also other benefits? Do you want to take a stab at that?
Yes. The water is used for domestic purposes as well as for feeding the animals. And you find that when our farmers have the water collected in the tank, they use less time that could have been used to fetch water. So that is an advantage because they can use that time to do other things. So we have seen that those farmers that have the water tanks, even the milk production has increased, which is a benefit. And to them, it is a plus. Thank you.
Thanks, Paul. I think there's a related question that came in the chat box, which was about, can you say a bit more about how ACLs or SACCO membership leads to more climate smart practices among dairy farmers? I don't know if you can speak to that. And Josh, maybe you want to come in as well based on what we've seen in the evidence.
Josh.
Yeah, I'm happy to jump in. I don't know how much we can say about climate smart practices in general, but I do think that, there are some specific ways in which we think that, water tanks are conducive to increasing the kind of the carbon efficiency of methane production, or the methane efficiency of dairy production, for example, by improving the kind of milk output per cow, allowing, increased output with the same or even fewer cows per farmer, which can have some impact on aggregate herd sizes and potentially impact overall methane emissions. We also think that this is just a really, a beneficial thing for climate resilience, and we have some preliminary evidence of that, as I think I mentioned during the presentation, that for farmers who do have access to water storage at home, we see evidence that they continue selling milk at much more consistent rates for weeks after the beginning of a dry spell, consistent with a kind of a climate resilience story. Paul, I don't know if you have any thoughts that you'd like to add on that.
Thanks, Josh. I'll get to the next question maybe for Paul, and then he can jump in. Paul, can you tell us a little bit about how the partnership with the dairy works? So are you able to offer ACLs to farmers in other dairies?
Thank you. How we work with the Nyara Dairy is that Nyara Dairy is concerned with the correction of milk and marketing. And after that, the payment is channeled to Quickers, DT Circle. So you find that we serve the same member, Therefore, when the milk payments are channeled to the SACCO, the payment for ACL loans, we deduct it through checkoffs. And also, it is very possible for us to scale up also to other dairies if only that they channel their production of milk payments to our SACCO, because when one becomes a member, we open all services and products to them. So it is very possible. Thank you.
Got it. Thanks, Paul. Go ahead, Abraham. Okay, sorry, I thought that was a comment. One more question here. Maybe this is for Abraham and Josh. How would this model work in settings where, there are no dairy cooperatives? So, how would farmers pay back the loan in settings where these dairy cooperatives don't exist?
Yeah, thanks. So dairy cooperatives are definitely a strong partner in how to make the repayments of the ACLs easy and low cost. And they're also a great way to get to know the creditworthiness of farmers due to their ability to deliver milk to the dairies on a consistent basis. I mean, generally because they aggregate repayments from many farmers from one dairy to a SACCO or other financial institution, this makes it a lower cost way of doing the transactions. So I think in other settings where there aren't dairy cooperatives, we'd definitely be losing a strong partner to this. But I do think that the main structure of the ACL, which is to use the water tank as a source of collateral that can be repossessed in case it's absolutely needed, but is highly valued by farmers and generally is not going to be at high risk of repossession, would still work even beyond a situation where there are a lot of strong dairy cooperatives. So even though it may not be the most efficient model that we've identified as it works in Kenya, I think that there could be other partners that could work with SACCOs to try to get some of the efficiencies that we've seen with dairy cooperatives, and still the water tank itself will be a good source of collateral for these loans.
Thanks, Abraham. Josh, do you want to comment as well?
Yeah, I mean, so it seems like just the model that the QuickCast has tested and now operated really successfully seems to work well, in part because it does have relatively low transaction costs. Many of the loan payments can be deducted automatically, which really reduces the cost of administering a program like this. Also because cooperatives themselves are member-owned institutions, they can exert some moral suasion to increase repayment rates relative perhaps to a commercial bank. And again, because the asset has relatively low depreciation, and so this may be a particularly good candidate. But the results from the research show that these loans are just exceptionally low risk, and that's corroborated by the many years that QuickUs has managed this program. And so it's very plausible that relaxing some of these features, such as the reliance on SACCOs or cooperatives even, could still plausibly result in profitable and useful loans with a modest degree of lending risk that could still work. For example, one could imagine that contract farming companies may be able to provide asset loans to their farmers with similar terms, given that they also have good visibility over farmers' income. And it could also very plausibly generalize to other agricultural sectors, and especially in sectors where farmers earn regular income, and so that there is some sort of institution that is paying out income to farmers on a regular basis and can easily integrate in loan repayments in this way.
Thanks, Josh. I think to your last point, there's a similar follow-up question I see in the Q&A box, which might be relevant for both you and Abraham, which is, has there been any interest from the Kenyan Ag Department or Livestock Department to integrate learnings from this model into any of their policies and programs?
Well, one of the things we've been doing is reaching out to the county governments. So agriculture is one of the devolved authorities to the counties in Kenya. And they keep track of their cooperative activities and the dairy sector. So from the counties we've spoken to, there's a great interest in using this appetite collateralized loan model to reach more dairy farmers, and a great concern about climate change and the risk of changing precipitation patterns. Generally, it has been more of a private sector-led initiative, as the SACCOs, the cooperatives themselves, and potentially other lenders are all private sector partners. But there's been a strong willingness among the county governments to help spread the information to more SACCOs, more dairy cooperatives, and in some cases help provide information and connection to the networks and the unions of dairy cooperatives and support the project in that way. That being said, there are also a government institution for lending agricultural credit, which we've spoken to, which also has expressed great interest in adopting some of these credit models that don't require a large amount of collateral. And they have spoken to us about how to integrate this into other asset lending plans that they have. And this could be a good candidate for them as a parastatal organization to increase the reach that they have in agricultural lending.
I would add one more thing, which is that there's been quite a bit of interest from the Commissioner of Cooperatives at the national level. So we do have some support from national the national government, as well as the great interest we've seen from the various county governments that we've spoken to.
Thanks both. Just shifting to the private sector a little bit. I see a question here, Abraham, maybe you want to come in. So is this potentially a significant market for the producers of water tanks? And has there been any involvement with them about supporting these scaling efforts?
Yeah, so we have developed quite a good relationship with one of the main tank suppliers in Kenya, which is called Containers. And they've worked with us in these scaling pilots that we've already been starting with a few dairy cooperatives in the country. And I think that while currently at the scale we're operating, it's not a huge market for them, but certainly if we're able to unlock some of this additional lending and scale up to a lot more dairies, they would be very interested in offering some way that they can contribute to this. The way that they've done it so far is definitely giving us some lower cost discounts for buying in bulk. But also there's a lot of logistics that has to go into making this efficient. And with the current pricing model, they've been able to offer prices for these water tanks, which are lower than a farmer would get at their local retail prices, and have it delivered up to their door from the factory itself. So because they have quite an extensive network of transport up and down the country to deliver this to their stockists, they're easily able to bring these tanks up to farmers' doorsteps on the same trucks that carry them to other locations. So this has been able to really reduce the price and make it easier and ensure quality control for the farmer side.
Thanks, Abraham. I think we have what is our last question, and it's for Josh. So have you seen a fluctuation in milk prices during this time frame? Thinking about other commodities such as coffee, cocoa, macadamia that might have larger fluctuations. And therefore, it might be more challenging for ACLs to get reliable payments due to these fluctuations.
My understanding is that there have been reasonable fluctuations in milk prices, and maybe Paul can speak to that as well. And that does have general impacts on farmers' sales, and presumably also the relative amount of their production that they allocate towards the dairy or potentially to other markets. And so it is, there's certainly value in an iterative approach to scaling that would test this model in different markets and test whether some of the features are could be better adapted for a particular use case. I think that the income sharing loan design that we're testing now in our project with PXD is a good candidate for this, because it builds in some of this natural, it builds in some resilience to income fluctuations, requiring smaller payments when incomes are relatively lower and larger payments when incomes are relatively higher. And thinking about loan design from this perspective, I think there's a lot of opportunity to innovate a little bit and make sure that this is a product that's well suited to farmers in a variety of sectors.
Thanks, Josh. I think with that, we will conclude this panel. I did want to flag that Neat has shared the video on the chat, and we will also be emailing it to you. Before we end, I want to acknowledge JPAL and Dai Rafte Foundation, who have supported the early stages of this work. thank you all of you for participating. It's been exciting to see so many of you join this and engage with this work. For us here at PXT, and I'm sure for many others on this call, we are super excited about the impact and scalability of the ACL model for water tanks. It's an evidence-based sustainable intervention that can transform how farming households access water. So we're excited to do more of this work. And if any of you are keen to join us on this journey, we'd love to chat. So please reach out. Thank you to all our panelists. We will follow up with the recording. And if anyone has further questions, please reach out via communications@precisiondev.org. We'll put that in the Q&A box. With that, we'll wrap up. Thanks, everyone.
Thanks.
Thank you, everyone.